No, that's good. And we're going to continue for a little while because I like the discussion. Dr. Cohn, you said that really one of the primary goals of the Federal Reserve is not to make money. That's correct. You have inflation and employment, but there probably are other ways there are infinite amount of ways they could address those goals. You might also argue that a central bank that loses money might not be a cause for bragging about, or that it might not be part of your goals to have a central bank that loses money, that it might not be comforting or accentuate or help with the idea of stability within the economy. I'm going to throw out a question that I think I just want to hear the response, and it may be a little bit off the wall. What if we had a banking system that was just based on fraud and lack of fraud? So if I give you money and you decide to loan it, you have to pay me interest, and we have a contract. I'm not going to come get my money for 5 years and you're going to loan it. And that's all you would loan, and we didn't have any other rules. And the interesting thing is this, about 25% of money that's loaned out is checking account money, but you don't have a contract with me. And the reason why the whole system is always a house of cards and could go under is if everybody wants to get their checking account money, it's not enough money. So basically, we have a fraudulent system. Fractional reserve is a fraudulent system. But what if you did nothing else? And I'm not asking you to advocate for the policy. I just want to know, about 25% of the deposits are checking. You could still loan some of it out if you tell me I can't. I can only remove 90% of my checking, that you'll pay me a little bit of interest. But right now, you take my checking account money and basically don't pay me anything, and you get, the banks get to make money on it. What if we just had a system of banking based on fraud? We'll start with Dr. Michelle.
Well, if I understand where you're going.
You can only loan out money that you have
Yeah.
permission to loan out, and you got to make an agreement with me. If you're going to loan my money out and give it to somebody else, I'm going to forgo it. You got to pay me some money, and you're going to take a portion of it. But I didn't make that. When I put my money in my checking account, I want it all there, but it's not all there because you're loaning it out. So that is a fraud. The banks are committing a fraud every day by loaning out my checking account money.
Well, I mean, that is disclosed. I wouldn't call that fraud, but if,
But what if you weren't allowed to loan out stuff you didn't have permission to, and let's just
that would be
say
good. If you
consider-
weren't allowed to loan out stuff that you didn't have permission to loan out, I'd be okay with that.
I guess it's too far outside the box. Mr. Westbury.
Well, actually, I'm going to take this in a little different way. We have FDIC insurance right now, so everybody's covered to $250,000. And I've always argued that we should get rid of that. Like that encourages banks to not, actually Silicon Valley Bank went under, we covered every penny of all their deposits. And what we should have is a system of gradation. I'm a bank, you give me your money, you want no risk. I take it and I buy treasury bills. And then you only then earn 2%. You'll take some risk. So I buy half treasury bills and I make some loans with the others, and now you earn 3%. Or you want all risk and I make all loans and you make 4%, and you get to choose. And then on the way out the door, you could buy insurance from Goldman Sachs. They have a desk at the door. You just bought that, you just deposited your money. You can get private insurance. And so what you're really getting to is where the depositor has control over how the money is used. And that's a system that's a free market system of dealing with insurance. Right now, we have government insurance on banking deposits, and that can lead to really risky bank behavior.
So I think that's called mutual funds, isn't it?
Well, it is, yeah.
So those things are available. So I wouldn't say it's based on fraud, Dr. Paul. I would say there is liquidity transformation in the system, and there always has been, in which the banks lend out at a longer term than they get their funds in demand deposits or savings deposits or short-term deposits. And that creates risk. And our country was subject before 1913, before the Fed was founded, to periodic recessions, very severe recessions when there were runs on the banks. The Fed was created to have a lending facility so the banks could meet those runs and wouldn't tighten the credit system and create very severe recession.
Essentially,
So there's
essentially-
risk in the system, and we need to make sure the banks are resilient and can take the risk and understand the risk, and the deposits at the Fed are one source of liquidity.
The reason there is a fraud that exists is that if 100% of people want their checking account money in every bank in America tomorrow, it's not there, right? So we still are liable for bank runs. The government just pays for it through the FDIC. And we still do have bank runs on occasion. You know, we have had some of these crises. Going back to the issue of the money supply tripling, and it's always fascinated me. I know it's not arithmetic. It isn't exactly. You don't triple it and have a third, prices go up as triple. But, and some of that, you could argue that the IRRB is, if you're going to have massive inflation, is a useful tool. But the opposite argument of that is if you have this useful tool, you're going to have a lot of inflation. It's a way to make inflation not so bad when you're going to pump tons of money into the system. But the counter argument would be maybe you shouldn't be pumping tons of money into the system. It's the same way with the Federal Reserve. You know, we have many people out there, you may not know them, but think we shouldn't have a Federal Reserve. But I always tell them, yeah, if we had a balanced budget every year, we probably could. You could have AI could run the system, have 1 or 2% inflation a year, and tell everybody what's going to be. It'd be very predictable, and we wouldn't have any ups and downs, swings of this. It just is what it is. You'd have great predictability, but you would have to balance your budget each year, so you didn't have to have these wild swings. And that was the whole thing of the pandemic, was this massive amount of borrowing and then all the flooding of money in there. Everybody got free checks. It was a terrible thing we did, and none of it was necessary, including the whole science behind making everybody crazy over COVID. Sure, it was bad, but it wasn't anything like the response to it. The response was insane. But going back to the inflation issue, I have just one other question, just sort of for the panel, is I've always wondered whether some of the reason we don't have as much inflation as the money supply created, or at least some of this, is that we export inflation in the sense that we import more than we export. So we're always sending dollars overseas over goods, and it's an enormous amount of money. And I know it equilibrates within the system, but we have entire countries that are on the dollar standard now. So as we inflate, I mean, there are whole countries in Africa where the only thing you see changing hands is dollars. South America, the same way. So is there is some facet of the lessening of inflation that all those dollars aren't chasing American goods? We export them and they're chasing worldwide goods, so we don't have quite the impact of inflation that we would have with the tripling of the money supply. Why don't we just go down, start with Dr. Michel?
From the studies that I'm familiar with, I would say no, that's not the primary reason.
Ryan?
I'd say dollars come back to the U.S. that come abroad generally in the form of foreign investment. If other countries choose to dollarize their economies, whether it's by importing dollars from here.
But I guess the question could be some of that investment goes into the stock market. So the stock market may have inflation, but the consumer price index isn't. So, I mean, you could be, that's what I'm asking. Could you be shifting some of it away from consumer price index and you see inflation in the stock market? But Mr. Westbury?
Yeah, there's a number of ways that the amount of money doesn't always equal the amount of inflation. And it's productivity. We never know where the money can go into. There are countries that are dollarized. They completely use dollars, and so that money is out of the system, and that means money growth doesn't matter as much. But a question or a point you just made before, I want to highlight something. Between 2020 and 2022, COVID, the federal government issued $7 trillion worth of debt. The Federal Reserve bought 45% of that debt. This is monetizing the debt. And the Fed always says they don't coordinate with the Treasury. And I would argue there's probably not a phone call that says, we're going to issue that, you're going to buy that. But isn't it interesting that quantitative easing happens at the same time we pass these huge spending bills? And then the Fed ends up buying over half of that debt. And the Fed does not have the same risk. They have a different risk tolerance than the banking system would. And so they will pay or accept a lower interest rate than the market would have in order to do this. So not only did we do crazy things during COVID that we overreacted, but we overspent, and then the Fed financed it. And that's one of the huge problems of this abundant reserve policy, is that the Fed is monetizing our debt. And
Yeah, and I
that's
think it's sort of
inflationary.
a corollary of what Friedman would say about spending, that nobody spends somebody else's money as wisely. It's the same with borrowing. Individual bankers and people who will lose their livelihood are going to be wiser, not because they're smarter people than at the Fed, but because they stand to lose more. They have a personal responsibility to it. Senator Johnson.
So I think the fact that the federal spending and the money supply and the QE were correlated were a separate response of the Congress and the Federal Reserve to what they perceived to be a very serious problem caused by COVID. There wasn't a cause and effect. I don't think the Trump-Biden deficits of 2020, 2021 would have been affected if interest rates had been a few basis points higher. The Congress wouldn't have passed those bills. That's not, I don't think that's, so they're both responding to the same thing. I think when you talked, Senator, Dr. Paul, about sort of the money supply allowing inflation, there's some truth there, because rather than the money supply causing inflation, the Fed supplies the amount of money people demand. You set an interest rate and you supply the money people demand at that interest rate. That's the way monetary policy has worked. And they demand more in inflation. If you want to stop the inflation, set the interest rate higher. They'll spend less, they'll demand more money, less money in those circumstances. And I do think the stability of our financial markets is really important for the inward investment, to see the dollar as the reserve currency, to see U.S. securities markets as the safest, most liquid markets in the world, is a very important piece of keeping the.
I think what causes inflation is an important question. So, Mr. Westbury?
Yeah, okay. The way you described monetary policy, that the Fed supplies the money that people demand, I would argue that is absolutely true prior to 2008. Because what abundant reserve policy does is it separates the money supply and interest rates. For example, yesterday we saw it. That we're going to change, we're going to buy $40 billion worth of bonds, but we're going to lower the interest rate at the same time. You didn't have to do both, or the Fed. You're not the Fed anymore, but you represent the Fed. But what we did is we completely separated. And when we changed from a scarce reserve system to an abundant reserve system, we took supply and demand out of interest rate markets. The Fed, or banks, used to trade federal funds every single day. Banks had a federal funds trading desk. The minute we started abundant reserves, all those desks are gone. There's no more jobs as federal funds traders because banks are overwhelmed with federal funds. They don't borrow them anymore. So you really don't have any way of knowing what the demand for money is anymore. It's not related to interest rates at all.
So I would say yes, IORB and ample reserves, abundant reserves, separated reserves and interest rates. Absolutely. The Fed's balance sheet and interest rates are now different, operate on different things. That's a feature, not a bug, in my view. A bug in your view, I get that. But I think the amount of money that people outside the Federal Reserve, not talking about banks, but people, you and me, Senator Johnson, Dr. Paul, demand in our bank accounts, that is not, it's not really affected by IORB. It's affected by the level of interest rates, right? So I think it's still M2, which is the stuff that people hold, is still demand determined based on the interest rate. The reserves part is not totally.
So let me try and